Welcome to my channel, and before you scroll past this, let me give you a reason to stay, because what you're about to hear is not about liking or disliking Donald Trump. It's not about red or blue. It's not even about politics the way most people think of it. This is about something far more important, and far more dangerous if you misunderstand it. Here's the hook you need to hear clearly. When federal agents raid properties tied to a former president, and headlines scream about a $3 billion asset seizure, the real shockwave doesn't hit Washington first. It hits confidence, it hits capital. It hits the quiet assumptions investors make every day about safety, rules and permanence, and most people won't realize what just changed until it's already cost them money. Now take a breath and slow this down with me. When news like this breaks, the average person reacts emotionally. They argue, they cheer. They panic, they share clips. They pick sides. But Warren Buffett never built wealth by reacting to headlines. He built it by asking a different question, while everyone else was shouting, "What does this mean 5, 10, 20 years from now, not tomorrow? Not this week, not the next news cycle." Long term, if you look at this situation through that lens, the first thing you notice is not Trump's name. It's the president. Markets don't fear individuals. Markets fear uncertainty, and nothing injects uncertainty faster than the perception that power, assets, and ownership can suddenly become unstable. A $3 billion seizure headline is not just a number. It's a psychological event. It tells business owners, investors, and institutions that visibility does not equal immunity. That scale does not guarantee protection, and that alone is enough to make capital pause. Buffett has said for decades that the most valuable thing in investing is not intelligence, it's temperament. This is one of those moments where temperament decides who survives and who self-destructs. Because here's the truth, most channels won't say out loud. The market hates chaos in the short term, but it often rewards clarity in the long term. The question is whether clarity follows this moment, or whether ambiguity becomes the new normal. If this raid signals stronger enforcement of existing laws, markets will eventually price it in and move on. Capital adapts quickly when rules are clear, even if they're strict. But if this moment signals selective enforcement, political unpredictability, or a widening gap between power and protection, then investors start demanding higher returns for higher risk. And that changes everything. Buffett doesn't speculate emotionally about headlines. He watches how institutions behave afterward. Do lenders tighten? Do insurers reprice risk? Do investors quietly move money offshore? Do businesses delay expansion? Those silent reactions matter far more than the shouting you see online. Think about this carefully. When fear enters the system, it doesn't announce itself with sirens. It whispers. It shows up as delayed decisions, higher premiums, lower multiples, and cautious boards. That's how wealth quietly shifts from the impatient to the prepared. This is where most people make their biggest mistake. They assume moments like this are signals to act fast, to sell, to buy, to jump, to run. Buffett does the opposite. He slows down even more. He asks, is this a permanent impairment or a temporary shock? If it's permanent, you protect capital first. If it's temporary, you look for opportunity while others are frozen. And here's the uncomfortable part. Many investors are not prepared for either scenario. They are over-leveraged, overconfident, and emotionally attached to narratives instead of numbers. A headline about a federal raid feels dramatic. But drama alone doesn't destroy wealth. Bad decisions made under pressure do. Buffett has always warned that leverage, combined with uncertainty, is toxic. When you don't know what the rules will look like tomorrow, debt stops being a tool and starts being a trap. That lesson applies whether you're a billionaire or someone managing a small portfolio. Now, let's talk about the bigger picture that almost no one is discussing. This moment forces a serious question about institutional trust. Trust is invisible when it's strong and painfully obvious when it's weakening. Markets are built on the assumption that contracts are honored, property rights are respected, and enforcement is predictable. When those assumptions feel even slightly unstable, capital doesn't protest, it relocates. Buffett understands that the most dangerous risks are not the ones you can model on a spreadsheet. They're the ones that change behavior quietly. Fear doesn't always crash markets. Sometimes it just slows them down for years. And while everyone else is obsessing over Trump's name in the headline, Buffett-style thinking is focused elsewhere. On banks, on insurers, on regulatory signals, on how capital flows adjust after the cameras leave. Because wealth isn't built by guessing outcomes. It's built by preparing for probabilities. If you're an investor, this is not the time to chase opinions. It's the time to review fundamentals. cash flow balance sheets, margin of safety businesses that can survive political cycles, regulatory shifts and media storms. Buffett has always said he sleeps well at night because the companies he owns don't depend on political favor. To survive, they sell products people use every day. They generate cash. They adapt. Ask yourself honestly, do your investments do the same? If your portfolio only works when everything goes right, then moments like this expose you. If your strategy depends on stability you don't control, then headlines like this should make you uncomfortable. That discomfort is information. Don't ignore it now. Here's where opportunity quietly enters the room. Moments of fear often create mispricing, not because businesses suddenly became bad, but because people suddenly became emotional. Long-term investors don't celebrate raids or panic over them. They observe whether quality assets are being thrown away. Because of sentiment, Buffett doesn't buy when the news is good. He buys when fear disconnects price from value. But he only does it when he understands the rules of the game well enough. Waiting is the hardest skill in investing. And it's the one most people don't have. So what should you actually take away from this moment? First, stop consuming noise. Noise makes you feel informed while making you reactive. Second, study how institutions respond, not how influencers react. Third, strengthen your margin of safety. Less debt, more cash flow. More patience, and finally, remember that headlines don't decide your future. Your response to them does. This is not about Trump. This is not about politics. This is about understanding how power, law, and capital interact in the real world. And if you learn that lesson now, this moment can make you wiser instead of poorer. Now let me leave you with this. Every major transfer of wealth in history happened during moments when most people were confused, emotional, and distracted. The winners weren't louder. They were calmer. They didn't predict the future. They prepared for it. If you want to think like that, if you want to learn how to stay rational, when headlines are designed to make you emotional, then you're in the right place. And here's my strong call to action. If this perspective challenged you, don't just watch and move on. Subscribe to this channel. Stay here because we don't chase breaking news. We break down what it really means. We don't follow noise, we follow logic. And we don't react like the crowd. We think like owners. Hit subscribe. Turn on notifications. And join a community that wants clarity when the world feels chaotic. Because in moments like this, calm thinking is not just an advantage, it's everything.